All right, today we're doing a deep dive into Haitian Precision, a major force in the global machine tool industry. And what we're seeing is a real paradox. The market is recovering, but the company's performance seems to be telling a completely different story. Let's break that down.
So here's how we're going to tackle this. We'll start with that core paradox I just mentioned. Then, we'll zoom out to look at the industry cycle, what's been happening in the broader market. From there, we'll try to explain the performance gap, look at Hayton's long-term strategic bets, and finally, we'll get into the numbers with a full financial deep dive.
Okay, let's get right into it. Section 1. The Paradox in Performance.
So here's the fundamental question we're trying to answer. The industry is on the upswing, so why are Haitian Precision's profits falling? Figuring out this disconnect is absolutely crucial to understanding where the company stands today and, more importantly, where it might be headed.
So, we're putting our core findings right up front. First off, the industry rebound is real. The metal cutting machine tool sector saw revenues jump 13.8% in the first half of 2025. But, and this is the key point, Haitian Precision's net profit actually fell by 19.3% in that same period. What this points to is a major tension between short-term margin pressures and the company's long-term strategic investments. And when we dig in, it's clear the driving factor here is declining profitability, not an issue with their operational efficiency.
Now, to really understand Haitian's situation, we need to look at the bigger picture. So, let's step back and examine the industry's recent roller coaster ride.
First, what does Haitian Precision actually make? Well, they build what are known as industrial mother machines. Think of these as the machines that make other machines. They're the highly automated, foundational tools that create precision parts for literally everything, from the engine block in your car to the casing on your smartphone. The health of this business is, in many ways, a barometer for the entire industrial economy.
And this industry has been through a really turbulent time. 2024 was brutal. Management even called it an involution-style price war. Basically, everyone was fighting for scraps in a shrinking market. But then, in early 2025, things changed. The government stepped in with a major equipment upgrade policy, and by the first half of the year, that stimulus really started to kick in, sparking an industry-wide recovery.
And the scale of that recovery? It's significant. We're talking about a 33% surge in total profit for the entire metal cutting machine tool industry in just the first half of 2025. Now, remember that number, because that's the baseline. That's the benchmark we need to measure Haitian Precision against.
Okay, so that brings us to the core of the issue. Let's start diagnosing the reasons for this performance gap.
So, based on the data, there are a few solid hypotheses for why this is happening. First, there could be a simple lag effect. Haitian focuses on huge, complex machines, and it just takes longer for an order to turn into revenue. Second, this could be a strategic choice. Maybe they're deliberately passing on low-margin deals to protect profitability in the long run. A third possibility is product focus. The initial recovery might be happening with smaller, standard machines, which isn't Haitian's core business. And finally, you just can't ignore the competitive pressure. It's possible their domestic rivals were just more aggressive in grabbing those first stimulus-driven orders. And that leads us right from the what to the why. Let's look at Haitian's forward-looking strategy, which is really defined by one major trade-off. You can see the strategic trade-off right here. On one hand, in 2024, net profit fell 14% because of all that margin pressure. But on the other hand, look at this. They increased their R&D spending by more than 21%. That's a classic counter-cyclical investment. They're sacrificing short-term profits to pour money into higher-end technology, betting it will pay off in the long run. And a really key part of this long-term bet is their unique platform advantage. See, Haitian Precision is part of the much larger Haitian Group, which is a global giant in injection molding machines. This means they can tap into a ready-made global sales and service network in over 130 countries. That kind of synergy is a massive advantage. It helps them expand internationally much faster and with a lot less risk than their competitors. All right, so we have the strategy. Now let's dive into the financial data and see how this story is actually playing out in the numbers.
So let's look at the key financial indicators. As we've discussed, you can see net profit and net profit margin are still trending down into the first half of 2025. But, and this is really interesting, look at the operating cash flow. It's telling a different story. It actually jumped 63.6% year over year. That's a strong positive signal. It suggests they're getting better at managing their working capital, even while profitability is taking a hit.
Now, if we use a DuPont analysis to break down their return on equity, or ROE, the picture gets even clearer. You see, ROE took a big hit, falling from over 28% down to 21% in 2024. But here's the key takeaway. That drop is almost entirely because of the squeeze on their net profit margin. The other pieces of the puzzle, like asset turnover and leverage, they've stayed pretty stable. This really isolates profitability as the main thing we need to watch.
Now, to get a sense of intrinsic value, the source analysis ran a discounted cash flow model. It's important to remember, this isn't a price prediction. It's an analytical tool based on different assumptions about the future. Under a base case scenario, the model points to a value of 16.30 CNY, but you can see how much that number changes under pessimistic or optimistic growth scenarios. It really just highlights how sensitive the company's valuation is to its future growth and profitability.
So, if we were to boil down the entire analysis into one sentence, it would be this. The company's current performance looks more like a temporary lag driven by strategy and timing than it does a signal of weakened competitiveness.
And that really leaves us with the one crucial question for anyone watching this company. Is this big, counter-cyclical investment in R&D and global expansion a bridge to a much more profitable future? Or will the brutal structural price wars in their home market end up wiping out all the gains from that long-term strategy? The answer to that question is what will define Hajian Precision's next chapter.